Thanks a lot for joining me on this Tuesday afternoon market recap. As you can see on my screen at the moment, this is the chart, the daily chart of the S&P 500 today. We pushed on up a further 84 points, just over 3% on the S&P 500. I think we are reaching very close to peak euphoria on what has been a relatively strong relief rally. We are now above that 50% Fibonacci retracement. We're pushing back on up into what appears to be the 61.8 Fibonacci retracement. A lot of silly people doing a lot of silly things in terms of buying this market. I know it has pushed a little bit further beyond that of our original resistance expectations. But again, there is such a plethora of resistance above current market action, whereby I still believe very soon, or sooner rather than later, we are going to see an adverse reaction to some of these resistance areas, which again are starting to, in terms of market breadth, begin to appear a little bit better. Generally, this happens right or very close to that initial turning point. I believe that we are still going to see a thrust down to close this window just here, 2,550, and ultimately come all the way back down to 2,325 points at an absolute minimum. I just wanted to point this video out. I left it yesterday because, again, we saw, pretty much a sideways move. We didn't really get all that much of a decent price swing either direction. We tried to fill the gap. We established that. Again, today we saw a little bit of a pop. The NASDAQ on a tear with, of course, Amazon and Netflix leading the tech companies higher. But again, it is very, or at least in my opinion, it is tunnel vision for the broader economy at this particular time. Very interesting to point out is that if I bring up the monthly chart and bring up the exponential moving averages, really common phenomenon is that when you actually break down below that of the 50 exponential, on a monthly chart, you come back on up to retest either the 10 or the 20, sideways moving exponential moving average on the monthly chart. Now, again, this is coming back into our red rectangular box of resistance. This is our general, resistance box where we assume that the market itself is going to, price in what will be that of an intermediate high. It's just been a question of, or how and how quickly, is actually going to achieve this. Are we still going to see that secondary dip to create what will be a longer term intermediate basing pattern, or are we simply just going to get this retest, straight done off the bat and then turn down into more of a prolonged grind? Now, again, it's still 50-50 at this particular point, as I alluded to a little bit earlier. We're above that 50% retracement. I think we came within roughly 15 to 16% of the recent all-time highs in February. And again, I'm calling this absolutely insanity, peak euphoria, whereby a lot of people, a lot of silly people, unfortunately, are doing a lot of silly transactions in the market, in the face and the weight of the evidence, whereby this is just simply going to produce that of a subsequent lower high. And there's a lot of empirical data, economic data, and also, of course, technical data to actually support that perspective on the marketplace. Now, again, if I just zoom out and show you this on the oscillating indicators, take a look at this on the monthly time frame. We are only still negligibly. The market itself is doing very little to actually turn up on the monthly time frame. This is very concerning because, again, we've got multi-month, multi-year divergences setting up, especially on the RSI and the MACD. Again, this is a very slow lagging indicator. However, again, it really dictates the broader and larger trend of the market. I understand that when we go back into the daily, we are pushing back on up into extreme oversold conditions. Again, this is interrelating into peak euphoria on this bounce. People are expecting this, and I don't really understand why that is, to see this market back on up at all-time highs when, of course, not only the US economy, but the global economy largely is still in absolute lockdown. Initial unemployment claims on average are rising, or the unemployment rate, people 1 million on average per day, that the US economy remains in lockdown. Again, this is all negative news for the market, and this is just essentially that of a clearing rally that has prolonged further than what initially I thought. I originally thought we'd turn down just shy of 2,750 right off this candlestick here. It still hasn't happened yet. It doesn't mean that it's not going to. If you find yourself sort of jumping into or trying to sort of offset that FOMO, it's natural. Don't worry about it. Please just don't do anything to put yourself in harm's way up and around this current price level, because sooner rather than later, we are going to see this market take a turn. It's going to come very suddenly, and it's going to shock a lot of people. This is just the honeypot drawing a lot of silly transactions, or people doing silly transactions into the marketplace very close to that critical area. If you go back out into a weekly time frame, it appears as though we're turning up. The histogram is decelerating. Once we get or very close to, I assume that this is going to happen very, very quickly. I don't think we're going to print into positive territory. In fact, I do believe this is going to turn back down and synchronize back into the daily time frame, whereby we see that or a sudden shock actually come back into the daily time frame, which again is then going to produce the synchronicity for that intermediate bottom, whereby we come back on down to close those open windows and then set up what will be a multi-month run. At this particular point, it's been about 4 weeks since this lower outside candlestick reversal over here. You can see here we've had a second, a third, and now this is the beginning of the fourth week. Last week it was an abbreviated week's worth of trade, as the initial claims in 3 weeks hit 17 million, not seen since the Great Depression. The S&P 500, I believe it had its best week since 1974. So again, you're seeing the dichotomy in a lot of people, in essence, again, just buying into that sort of false optimism, right, which is in otherwise called a counter trend move, right? A bear rally, so to speak, right up until the point it reverses hard. And a lot of people are going to be scrambling to actually sell to close a lot of those original positions when that time happens. I know it feels, or at least it can feel, very hard to sort of sit on the sidelines, not actually participate in this rally. If you've missed this, don't beat yourself up, because these windows, they will close, and it is going to happen relatively soon. I don't see this really lasting for all that much longer. I'd be shocked, so to speak, if we haven't closed this window within 2 weeks, and this one maybe a month from now. So again, we're right at that extreme. Very close to being exceptionally overbought once again on the daily time frame. This MACD, you can already see it. It's starting to trail off on the daily time frame. Again, this is just the distance between the short and, of course, the faster signal line over here. Again, once this gets moving to move back in synchronicity with the weekly time frame, that at this particular point on the stochastics appears to be turning up. It's got very similar sort of circumstances. Again, back into that parallel that I've been talking about back at the back end of the fourth quarter of 2018. This is going to happen very suddenly. And then when it does, it's going to produce that true intermediate bottom, whether or not it actually takes out this swing low over here. I think the evidence at this particular point is just calling for the actual closure of this window. But again, time will tell. I know there's probably going to be a few comments over here talking about the Fed. I understand that. Again, at this particular point, I believe the stimulus is somewhere between 4 trillion. The bond market itself is exceptionally larger. A lot of people are talking about how this is contained once again. I beg to differ. I truly beg to differ at this particular point. But again, if you want to jump in and buy this market, by all means, just think twice before doing so. That's really all I'm going to say. I understand it feels as though everything's getting better. We've spoken about the S-curve acceleration of new cases in the coronavirus. We've been talking about this rally, which again would follow suit. I think at some point we are going to see this turn down, probably relatively soon, and we'll take it from there. But as it stands, again, we're coming back on up, at least on the monthly time frame, to retest a lot of these very important overhead resistance areas. A very interesting stat too is that if you go back and study this retrospectively, of course, if you go back to every major market top, the final sort of, I guess you could say, fork in it is when the 10 crosses the 20, right? So when this teal colored line crosses this pink line, when that happens, it's all but done. We're obviously seeing the unemployment rate move above that 36-month smooth moving average. We're going to get the LEIs coming out this Friday, which is going to be very important. I think this is very much so going to be reassuring for, I guess, our thesis, our narrative on what's happening in the marketplace at this particular point. So again, stay tuned and really dial in for that Friday report. It's going to be very important. Again, I feel as though it's going to be very sort of reassuring as to where we are economically speaking. And of course, it's really going to confirm this euphoria that we're seeing in the markets at the moment. But again, just keep a cool head, be objective in the analysis. And I think sooner rather than later, again, just to repeat myself, I know I have, we are going to see a critical resistance area hold. I mean, we could see the S&P 500 technically come back up to say 3,000 points. Again, that's going to correlate very nicely with that 61.8 Fibonacci retracement. I still don't think we're actually going to do it. But I think we're actually going to turn down between the 50 and the 61.8% retracement. All right, that's what my hunch and my gut is telling me. But what's very, very obvious at this particular point is that volume is trailing out of this market. Volume is also trailing out of a bunch of individual stocks as well, some past historical market leaders. The volume's just simply not there outside of, right, some of the price action that we've seen in Amazon, and Google have been really the primary beneficiaries of this entire lockdown. So outside the scope of those two sort of historical market leaders, so to speak, we're really not seeing any confirmation in terms of market breadth. In fact, if I actually show you this, not to just jump into the transportation average, but more so secondary into the Russell 2000, you can see that we're already starting to create a little bit of a divergence here. If I can show you this in the price action, if my screen wants to work with me, push number 4 on my keyboard. There you go. You can see it right here. We've created a higher high. At the same time, these oscillators are still turning down. And when I show you this in the Russell 2000 as well, very similar picture. We have established a higher high. This is ultimately going to fizzle. It's going to fade. It's going to reverse. And you can just see it turning down very close on these stochastics right now as we're just pushing back on up into oversold, whereby, again, largely we're just simply moving sideways over the past number of sessions. So keep an eye on that. Again, I understand it's very hard to emotionally disconnect from the market when you see it retracing a fair portion, or at least 50% at this sort of current time of this initial first wave sell-off. And again, it's leading a lot of people, unfortunately, a lot of people who are unconditioned to do a lot of knee-jerk, right, purely emotional transactions. And that is not going to end well for those people, right? I'm not diverging whatsoever from our base case analysis. In fact, we were very cautious prior to the turn down. We haven't really done anything in the calendar year of 2020 leading up to the market top, right? We were speaking about this inevitable bounce and then ultimately the secondary retest of this support area. I still firmly believe this is going to happen, and we'll be obviously justified for that in a little bit of time. So really just stay healthy, stay safe, all right? And also just try and stay patient. I understand you probably want to jump back into the market and do all sorts of things, but really if there's anything to do, it would really be taking, of course, the macro trend directional trade, which on the monthly time frame, and again, this very rarely happens in monthly cycles, is to actually, trade in the direction of these oscillators, especially that of the MACD. When this happens, it's a major, major warning. And largely what you can think about is that this market is range bound. It's coming back on up into that top resistance area. Generally, we're going to get that secondary retest, which if you look back on it, probably over a 3-month duration, it's going to look like a macro topping pattern as well. So don't get swept up in the daily time frame. I know it's very exciting when you see the S&P 500 again up 3% and again continuing to claw back a large portion of these initial losses. This isn't going to end well. All right, this isn't going to end well. I'm going to leave it at that as at this Tuesday afternoon market recap. Again, just sitting tight, looking at these triggers, just waiting for them to actually trigger. You can see here 2,633 on the S&P 500 on my chart at this particular time. Haven't moved that whatsoever. That'll just sit there up until a point whereby the market's turned down, and then we'll just jump on the action to the downside when that shows up. Whether or not it's here or whether it's up at the 61.8% retracement, okay, it's really immaterial at this particular point. What you want to be prepared for is that swing, right? That coming swing, which is going to happen. Okay, so on that note, everyone, I'm going to say farewell to you as at this Tuesday afternoon market recap. Stay safe, stay healthy, and also stay patient too. It's James signing off on behalf of Pivot Point Trading. Farewell.